Okay, let's dive right into this. Welcome to The Explainer. Today, we're unpacking a really powerful, step-by-step blueprint for investing your first $10,000 safely and strategically. Whether you have exactly $10,000 sitting in the bank right now, or you're diligently working your way there, this is the plan for putting your hard-earned money to work. So, what would you do with $10,000 right now? Seriously, think about it. Having that kind of cash buffer feels amazing. It gives you the confidence to make bigger life decisions. It makes it so much easier to walk away from a bad job or a situation that just isn't serving you anymore. It gives you incredible peace of mind. But here is the challenge I want to put to you today. Could that money be working even harder for you?
Here is our roadmap for today. First, the first 10,000. Second, why savings are lazy. Third, the magic of compounding. Fourth, your simple investment blueprint. And finally, 3 costly rookie mistakes.
All right, part 1, the first 10,000. Now, before we take any risks at all, we have to talk about your foundation. And that comes down to this number, 3 to 9. This represents the months of living expenses you need saved up as an emergency fund before you even think about investing. Listen, your cautious instincts about holding on to cash are completely valid here. If you're single with just yourself to think about, 3 months is a solid target. If you have dependents, a partner, or kids, you want to aim for 6 months. And if you just want to be extra cautious, go for 9 months of living expenses tucked safely away. This is your sleep perfectly soundly at night fund.
Moving on to part 2, why savings are lazy.
And this brilliantly illustrates the hidden dangers of playing it too safe. In one scenario, we've got lazy savings earning a decent 4%. In the other, working investments in a diversified portfolio earning around 8%. If you leave $10,000 in that savings account for 10 years, you'll have just under $15,000. But if you move it to that 8% investment account, you'd have over $21,000. The rest of your life goes about exactly the same way. You've only made one single decision of where to park your money, but the difference in your net worth is absolutely staggering. But, keeping cash is actually way riskier than it looks, and that's because of inflation. To put that into perspective, goods and services that cost $10,000 back in 1990 would cost you almost $25,000 today. Your groceries, your rent, your energy bills, it all constantly goes up. Inflation is basically an invisible thief slowly swiping cash right out of your wallet while you sleep. Your bank balance might look like it's growing, but its actual buying power is shrinking. Investing is how you fight back.
Which brings us to part 3, the magic of compounding.
Let's see how this builds over time. This is what happens when you invest $10,000 at an 8% average annual return, and then you just forget about it. You never add another penny. Year 1, it grows to $10,800. Okay, good, but not exactly life-changing. But look at year 2, $11,664. By year 10, you've more than doubled your money to $21,600. And by year 20, you're sitting at roughly $46,600. This is compound interest. Your investment returns are literally earning their own returns. The snowball just keeps rolling.
All right, part 4, your simple investment blueprint.
Let's move to exactly how and where to execute these investments. You really want to treat this hierarchy strictly. Step 1 is always your workplace pension or retirement scheme, specifically if your employer offers a match. Listen, that match is literally free money, and you will never ever beat that kind of guaranteed return anywhere else. Step 2 is opening a tax-free investment account, like an ISA in the UK or similar tax-advantaged accounts globally. You want to try to max this out each year so your money grows without the drag of taxes. Only once you've exhausted those limits should you move to step 3, which is a general, taxable investment account.
Now, people often ask, well, what about property? Property can be great, for sure, but the barrier to entry is a whole different ballgame. Stocks and funds have an incredibly low barrier to entry. A lot of modern platforms let you start investing with less money than you'd spend on a cup of coffee, and it is entirely passive. Property investing requires massive deposits that can take years to save. Plus, you have maintenance costs, taxes, and the headache of landlord responsibilities. Stocks are simply far easier to get into and require zero physical maintenance.
So what exactly should you buy? The secret is to keep it incredibly simple. As a beginner, you want broad, globally diversified funds. An S&P 500 fund or an all-world index fund is a really solid starting point. This gives you safety in numbers because you're instantly diversifying your money across hundreds, even thousands of top companies across different regions. But hey, a quick warning, pay close attention to the fees. High fund fees will massively impact your long-term return, so definitely look for low-cost options.
Finally, part 5, 3 costly rookie mistakes.
Now, what's really interesting about these numbers is seeing the devastating cost of mistake number 1, which is procrastinating out of fear. If you wait to invest that $10,000 until you're 35 because maybe you're a bit scared and want to read just one more book first, you'll have about $68,000 by the time you're 60. But if you just start at age 25, that exact same $10,000 grows to over $100,000 by your 60th birthday. Waiting 10 years out of fear literally costs you tens of thousands of dollars in lost compounding.
You really don't need to find the absolute perfect investment on day one. You just need to remember this golden rule. Time in the market matters far more than timing the market. History completely proves this. If you look at the S&P 500, investors who made an investment and held it uninterrupted for a 20-year period almost never lost money. I mean, that includes holding through the Great Depression, the tech bubble, and the 2008 financial crisis. The key is just getting in and staying in. Mistake number 2 is chasing trends. We've all been there, right? You learn the basics, and suddenly you feel like a financial genius ready to spot the next big crypto coin. Well, that is the Dunning-Kruger effect. It's when you don't yet know enough to realize how little you actually know. This totally natural, early confidence makes beginners throw money at unproven trends. If you absolutely must pick individual stocks, please limit it to a tiny portion of your portfolio. Treat it as fun money, enough to learn from, but definitely not enough to lose sleep over.
And that brings us to mistake number 3. Materializing your losses. Look, when the stock market drops, our immediate human instinct is to panic and pull our money out. But doing that instantly locks in your loss. You take a temporary dip on paper and you make it a permanent reality. The best investors do the exact opposite. They stay calm. And remember that emergency fund we built back in section 1? That is exactly what protects you here. Because your short-term living expenses are safely covered by cash, your emotional brain doesn't need to take over. Your logical investor brain can stay fully in control.
So the crucial point is really bringing all this together. Let's lock in your new financial blueprint. 1. Build your emergency foundation first so you're never tempted to panic sell. 2. Pay off any expensive, high-interest debt so you aren't taking 1 step forward and 2 steps back. 3. Prioritize your workplace matches and tax-free accounts for maximum efficiency. 4. Automate your investments and literally log out of your accounts. Don't watch the market fluctuations like a hawk. And 5. Relax. Just let the power of compounding do the heavy lifting for you so you can focus on actually enjoying your life.
Now that you have the blueprint, what's your very first step today? Are you going to check your emergency fund or finally open up that tax-free account? Getting that first $10,000 working for you takes a little bit of structure, but once it's running, your wealth begins to scale effortlessly. Which leaves you with one thought. What if the absolute biggest financial risk you can take right now isn't the stock market, but simply waiting another day to start? Thanks for joining us, and I'll see you in the next explainer.